Well, what a week it's been for US markets, hit again by pandemic-fueled volatility, leading to their worst performance in 3 decades. Intervention from the Federal Reserve and the government seemed to stem the sell-off for a little, but volatility is expected to continue well into next week. Gregory spoke to Tim Anderson, Managing Director of Equity Market Strategy at TJM Investments, on the week's wild ride.
Well, it will go on for a while, probably not to the extent that we saw the first half of this week and even the prior week, but you got to realize we are down close to 30% from the highs just over a month ago on the major market averages. And there's a level down here where if the S&P 500 can continue to hold that closing low level from December 24, 2018, which is around the 2350 level, and then NASDAQ is still 10% at least, maybe a little bit more, maybe 12% today, above that level. That was about 61.90. Then investors will start to get some confidence that, you know what, this is a little crazy. I don't want to go full bore in yet, but the risk-reward trade is starting to look toward the long side.
So in terms of markets, though, we've seen action from the Fed moving to shore up markets. We've had that announcement of government stimulus. When are we going to see that take effect and boost investor sentiment?
Well, investor sentiment will take a while. The Fed action, I think, is already in play, and there's probably still some more Fed action to take place. Now, the big 1% interest rate cut is the big headline, but there's a lot of other things that the Fed can do. Obviously, we learned about QE 10 years ago. They are buying a lot of bonds, and they're doing very large repo operations overnight. But there's other things they're doing, like funding the commercial paper fund facility, which is very important. They're basically guaranteeing A1, P1 commercial paper, which when the commercial paper market seized up 12 years ago, that was a big problem at the beginning of the financial crisis. There are other things that they can do. I mean, just up the street, there's 300 or 400 people at the Fed that model things all the time, 99% of which never happens, almost like they do with the Pentagon.
Now, obviously, the shutting of the trading floor here at Wall Street, the New York Stock Exchange this week. What's the mood like there at the moment with investors and going into a new week? What are they thinking? What's the outlook?
Well, the big question, of course, is how much liquidity will the exchange lose if you don't have people on the floor in terms of brokers handling the human side of their hybrid market, which has really been, you know, human interaction, human orders, heavily concentrated around the opening and around the close, and how much market share they might lose to the NASDAQ if they're going to be totally electronic, which of course the NASDAQ always has been. So it's a little pensive, but I'm sure they'll be taking a very hard look at the data through next week to judge, you know, how soon they really want to rush people back onto the floor.
Okay, and overall, just finally, how low do you think markets can go? Obviously, we've had some really terrible days here, some really dire days on markets, and again, just that huge volatility, those swings. What are we seeing? How low do you think they can go?
I really think we're close to a bottom at the lows of Wednesday, which some people are calling the Ackman bottom. He got on another financial news network and started ranting about worst case scenarios and the end of the world. The market rallied 1,000 points off that low Wednesday afternoon. You gotta watch that 2350 level on the S&P 500. That was the closing low the day before Christmas 2018. And if the NASDAQ gets close to that 6,200 level, that was the closing low for NASDAQ. That's down about 30% in the month. It's an astronomical drop. I'm not saying we can't go lower, but it feels like we're very close to a tradable level. We just need visibility on progress in beating the virus.